Coming up on market shares, the January job report is surprising economists with 500,000 new jobs. See what sectors are adding the most.
Plus, one of Juul Labs' earliest investors joins the show. See what he has to say about the company's future.
And gas companies, including ExxonMobil, are reporting record profits for 2022. See how the White House is reacting to these reports. Hold on to your wallets, because market shares starts right now.
Good morning and welcome into Market Shares. I'm Tegan Brown.
And I'm Bradley Hoppenstein. We start off today with our market update per usual. Now, big story this week was the jobs report. The markets were up on the Fed raising rates, but dipped a bit to end the week. Let's take a look at the Dow to start us off. The Dow ending the week falling about 128 points Friday to 33,926 to end the week. And it really comes down to investors being worried the Fed is going to keep hiking interest rates, especially with that jobs report. Some investors think a hot economy could give the Fed more reason to raise rates, but regardless, the broader market index, the NASDAQ and S&P, notched a bit of a flatter week, but still positive on the jobs report. Tegan.
Yeah, the NASDAQ coming up. We had the 5th straight week of gains for this. That's the longest streak since November of 2021, so a lot of promise there. But companies like Apple and Amazon weren't exactly where investors wanted them to be, but investors were more focused on what companies were doing this week to cut costs. Plus, the NASDAQ plummeted 33% in 2022, so now that it's up 15% from the beginning of the year, it's a lot of promise right now for the NASDAQ.
All right, and then just a quick note on the S&P. The S&P rose 1.4%. It actually closed its highest level since late August on Thursday. The S&P closed the week higher by just over 1 percentage point. Slight dip Friday after the jobs report. So let's get to that jobs report. It's actually some good news to top our show today with that jobs report. The U.S. adding a stunning 517,000 jobs in January. The expected number, only 185,000. Job market's still red hot, even with some of those layoffs Tegan mentioned. We've seen them in the tech sector, and the Fed's concerted push to slow economic growth. Still seeing a lot of jobs. The unemployment rate now at its lowest since 1969. That sits at 3.4%.
And the government also revised estimates for 2022 to show the economy added over 500,000 more jobs than initially estimated. The leisure and hospitality sector led January's gains with 128,000, followed by business services with 82,000 and healthcare after that with 79,000. Employment in the information sector, mainly tech, was equal to December. It lost about 5,000 jobs, as many as those companies have been cutting their headcounts.
U.S. Secretary of Labor Marty Walsh released a statement on the positive jobs numbers. He says, quote, "We are truly seeing what it looks like to build an economy from the bottom up and the middle out. At the Department of Labor, we remain focused on making sure all the jobs being created are good jobs and making sure all workers have access to these opportunities."
And now we're no closer to a debt ceiling deal. House Speaker Kevin McCarthy says he and President Biden will meet again. Before we talk about that, let's actually talk about our market movers, Bradley.
Yes, let's talk about those market movers. So let's take a look here. Let's start with Alphabet, if we could get that queued up. Shares for Alphabet fell about 3% on Friday, and Alphabet, of course, Google's parent company. That really comes down. Their ad revenue fell in the fourth quarter, but that being said, it's only the second time their sales have fallen since they became publicly traded in 2004. It's an overall slowdown in the tech marketing space, but of course, there's also that lawsuit with the DOJ that is imminent for Google.
Yeah, next up we have Ford, which, you look at it, it's in the positive right now, but it actually took a pretty big dip at the very end of the week. Did a good majority in it, some solid gains, but had some issues with Wall Street at the end because stock fell 6% after a disappointing quarter. And basically, execs on Wall Street are blaming this, on high cost of production for gas-powered vehicles, as well as that shift to electronic that we're seeing.
And Apple also dipped a bit to end the week. The tech giant ended a 3-year streak of sales growth. The Q1 revenue decline and manufacturing issues in China are largely to blame. Apple's been having a lot of issues for a few years now with China, and their shares dipped a little to end the week. All right, now let's get to that debt
All
ceiling.
right, now
Tegan.
let's get to that. We are still no closer to a debt ceiling deal. House Speaker Kevin McCarthy says he and President Biden will meet again soon to continue talks about how and when to raise the nation's debt ceiling. The two met on Wednesday and both say passing a debt limit bill is essential, but they are at odds on how exactly to do that. Biden and the White House have so far refused to negotiate on a debt limit hike. He wants Congress to pass a clean bill with no legislative strings attached. McCarthy said on Thursday that's not going to happen, saying there needs to be spending reform for the House to pass a bill.
And Meta is making another play for the metaverse. After some back and forth between the Federal Trade Commission and Facebook, a federal judge is letting its acquisition of VR startup Within Unlimited go through. The FTC sued in July to block the deal, calling Facebook a global technology behemoth. But in a sealed court decision Tuesday night, a U.S. district judge denied the FTC's request for an injunction blocking the proposed merger. And more layoffs this week. This time, the big name FedEx. The shipping giant is cutting more than 10% of its officers and directors. It's cutting those corporate jobs to lower costs, with demand slowing down in the shipping industry after a pandemic surge. Other notable names announcing layoffs this week include DraftKings, cutting 3.5% of its global workforce. EV maker Rivian is slashing 6% of its staff. And Hasbro, which we saw trending in the wrong direction on our market movers last week, they announced they're cutting 15% of their global workforce by the end of this year.
And in the face of all of these continuing tech layoffs, Intel CEO Pat Gelsinger has taken a pay cut after the company saw a downgrade in its credit rating. The chipmaker recently posted quarterly earnings that disappointed Wall Street and lowered their stock significantly. Gelsinger is taking a 25% pay cut and applying cuts all across the company in an attempt to reserve cash. And Juul Labs, the embattled e-cigarette manufacturer, is still struggling to stay afloat amid a litany of legal and regulatory challenges. Market Shares reporter Peter Elliott spoke with one key investor about his position in the once dominant vaping company. Peter.
Yeah, Bradley, it was just 5 years ago that Juul was the crown jewel of the e-cigarette industry, with a commanding market share of almost 3/4. But the company's vice grip on the vaping world has uncoupled significantly since those halcyon days, as it struggles to keep its products on the market while fighting a torrent of legal challenges. The company, of course, has faced significant regulatory scrutiny for marketing its products to young people. Juul is one of the more spectacular rises and falls that the business world has seen in quite some time. And one person who has ridden the wave since the very beginning is venture capitalist Greg Smith, who purchased a 1.5% share of the company back in 2015. We caught up with Smith earlier this week and asked how he feels now about his now beleaguered investment 8 years later. Well, I talked with Smith extensively about his position in the company, and he says he feels good about the company, that it's intended for smokers and not for people trying to get into vaping. Now, Smith said he was actually a smoker addicted to cigarettes for about 8 years, starting in high school, and he has actually never smoked a Juul, but he said he would rather his children use Juuls than actually cigarettes. Although, however, one of the leading investors in Juul, tobacco companies like what was formerly Philip Morris International. Smith says that in spite of all the trouble that Juul has endured, he's still an active investor with hope for the future of the company, which could be on the horizon. The Wall Street Journal reported last month that Juul was in early stage talks with 3 major players in the tobacco industry over a potential sale or investment. So while its future is still cloudy, it's clear that Juul still sparkles as an investment opportunity. Bradley and Tegan.
Peter, thank you so much. And coming up on Market Shares, Exxon and Chevron are reporting record profits after a year of record high gas prices. See how the White House responded when we come back.
Well, Thomas, you've got pre-diabetes. But with more exercise and a change in diet, it can be reversed.
I've tried exercising. It just makes me hungry for bacon.
I love bacon, too. And who really likes to exercise?
Not me.
Me neither.
Nobody. So we're good?
What? Oh, you still have pre-diabetes. Big time.
If you see news happening on campus, in Syracuse, or across the nation, call the CitrusTV newsroom, 315-443-1177, or tweet at CitrusTV News, your campus news leader.
Welcome back to Market Shares. Gas prices hit record highs in the U.S. last year, but so did oil company profits. Market Shares political analyst Luke Radel is joining us now. Luke, talk to me. Who's being blamed for these sky-high fuel costs?
Tegan and Bradley, the main culprit for the blame in the past year and a half, President Joe Biden. He's been blamed and held responsible for these high gas prices by many figures in politics, including Texas Senator Ted Cruz, who spoke about this issue through the lens of history.
Harry Truman famously had on his desk a plaque that said, "The buck stops here." Joe Biden seems to have replaced that plaque with instead the phrase, "The buck stops with Putin," because nothing is Joe Biden's fault. Well, I'll tell you what, the little stickers on gas pumps all across the country illustrate the American people know exactly whose fault this is.
That's right. You've probably seen these little stickers slapped across gas pumps around the U.S., but it may surprise you to learn that just because something is written on a sticker doesn't mean it's true. The White House has pointed to the major news this week that oil companies ExxonMobil and Chevron reported that they hit company record profits last year. They note that Exxon reported $56 billion in profit, while Americans struggled to pay for fuel. Here's President Biden making this argument leading up to the midterm elections.
But rather than increasing their investments in America or giving American consumers a break, their excess profits are going back to their shareholders and they're buying back their stock, so the executive pays are going to skyrocket. Give me a break. Enough is enough.
But despite the president's criticism, these earnings reports give oil companies no good reason to try and lower their prices. And the reported future plans won't help either. In elementary supply and demand, it follows that to lower prices, oil companies would need to increase the supply of fuel through expanded oil drilling and exploration. The White House has tried to incentivize new oil drilling, a move that's been largely criticized by climate activists in the president's own party. Biden granted more drilling permits in his first 2 years in office than even former President Trump did. But still, oil companies have limited plans for expansion and seem to have found a different use for those record profits. Chevron announced that it'll be buying back $75 billion of its own stock to boost shareholders, a move that was criticized by the White House this week. In a statement, spokesperson for the White House, Abdullah Hassan, reacted to the news of Chevron's buyback by saying, quote, "For a company that claimed not too long ago that it was working hard to increase oil production, handing out $75 billion to executives and wealthy shareholders sure is an odd way to show it." And Tegan and Brad, the national average for gas prices sits around $3.50 a gallon.
So now, Luke, you were talking about people blaming President Joe Biden, those stickers that you see all the time on gas pumps. What exactly is the White House doing to alleviate the cost of fuel?
Yeah, so we obviously talked about the fact that President Biden has approved a record number of oil drilling permits, more than many of his predecessors, including Obama and Trump. He's also released over 1 million barrels of oil every day from the nation's strategic petroleum reserve, hoping to increase that supply in order to lower those prices.
And Luke, how have oil company executives responded to this move?
Yeah, so Exxon has pointed out, and Chevron as well, that these stock buybacks come after a long period of decline in the oil and gas industry. Remember, during the pandemic, many people weren't going out and using gas, and so gas prices fell to record lows. So did stock and record profits for these companies. Exxon reported losses in the year 2020, so now they're pointing out that they want to pay back those shareholders for staying with them during those troubled times.
And coming up after the break, our reporter Jacob Goldberg will have more on. Excuse us, and switching over. Switching over to the international front, officials from the U.S. and India reached an agreement to expand cooperation on trade last week. According to U.S. officials, the move looks to strengthen the economic and geopolitical partnership between both nations. Here to discuss the implications of this agreement is Market Shares analyst Dominic Chapone. Dominic, what's the angle President Biden is looking to play here with these negotiations?
Well, Tegan, since the 2022 midterms concluded, it appears the Biden administration shifted its focus from the domestic front to the international one. These latest developments all tie into what's been circulating in the news in recent weeks. The Biden administration is focusing on expanding cooperation on advanced weaponry, supercomputing, and semiconductor production. The primary industrial focus is in the high-tech world, hoping to mainly strengthen its relationships with major Asian countries in light of China's efforts to do the exact same. Now, during the end of 2022 and beginning of 2023, President Biden's target goal has been touting his resume on America's economic progress coming out of the pandemic and with changes in the work sphere. In regards to the economy, President Biden consistently preaches investment as a means of growth here in the U.S. Take a listen.
You can't be the #1 economy, the strongest economy in the world, without the best infrastructure in the world. It's not possible. Don't have the best trains, planes, airports, and the like. You can't do it.
Now, that mainly came through the lens of economic investments like the American Rescue Plan and the Bipartisan Infrastructure Act. But to begin this year, Biden's economic mentality is transitioning to the international sphere, particularly against the rising and growing influence of China. Now, that mainly came through the lens of economic investment. My apologies for that. We're having some technical difficulties, but in terms of China's latest moves, obviously with the Chinese spy balloon, as well as China's continued push toward its Belt and Road Initiative, we've seen a lot of news recently for China in recent weeks. There we go. Sorry about that. So obviously, China has been in the headlines in recent weeks, mainly through allegations of spy balloons, one over Montana in the U.S. and the other one in Latin America. We've also seen that reports came out that China has had consistent involvement in helping out Russia in its push to invade Ukraine. And then lastly, its continued economic incentives to move into Africa as well as Asia.
Dom, thank you. Dom now joining us at the desk. So like you said, a lot of talk about China in the past week. The latest of many, many things. The spy balloon, the surveillance balloon, but what is President Biden looking to achieve with this move?
The ultimate goal here at the end of the day is to counteract Chinese influence, especially when it comes to the economic sector. One of the reasons behind this is that we've already seen Biden have a big investment here in the U.S. on semiconductor production, even looking right here in Syracuse, but it's also been in the high-tech world. Biden has stressed repeatedly the idea of if you invest in your own infrastructure, you therefore can boost the long-term growth of the economy. I think that's ultimately what the target goal is here. There's also a domestic front angle, but there's also the international perspective as well with counteracting China's recent growth.
You mentioned that domestic angle. I mean, we've talked a lot about this international outlook of it and everything, but how is this investment going to affect us right here on the domestic front in the U.S.?
Yeah, at the end of the day, one of the biggest problems, I think, with America's economy is that we are still, as Biden said in his speech, still the strongest, one of the strongest, if not the strongest economies in the world right now. But in terms of the long-term outlook, I think that's where the trouble lies. Again, like a lot of the infrastructure and a lot of the system built on America's economy is kind of decades old, even feels like it's like from the 60s or 70s. So the idea behind this is to catch America up with a lot of these countries, especially like India, China, a lot of other nations in Western Europe, where their infrastructure itself is just vastly ahead compared to the U.S.
All right, Dom, thank you. Coming up after the break, the Fed is raising rates again. We'll break down the numbers.
Look at you. You're at the top of your game. You're unstoppable. Nothing can throw you off track. Wait, is that your car? Uh-oh. Yeah, I saw that coming. That will throw you off track. You're looking at around 10 grand in fines, legal fees, and increased insurance rates. Let's try this again. Smart move. Because buzz driving is drunk driving.
If you see news happening on campus, in Syracuse, or across the nation, Call the CitrusTV newsroom, 315-443-1177, or tweet at CitrusTV News, your campus news leader.
Welcome back to Market Shares. The Federal Reserve is raising interest rates again. With hundreds of millions of Americans affected by the recent spike in interest rates, Market Shares analyst Jacob Goldberg is here to break down the reasons for the hike. Jacob?
Thanks, guys. Well, before we take a look at the current interest rates in 2022 to 2023, I think it's a good time we look at the past. You see, 2008 interest rates were above 5%, the highest they've been. They've not gotten back there since. And what does the pink represent? Well, that represents the recessions we've seen in the United States. The housing crisis in 2008. Interest rates really high right before a recession, they lower during it. We see the same thing with the COVID-19 pandemic, rising interest rates, recession goes low. We're seeing the same thing in 2023, so you might think to yourself, well, the U.S. is heading in a recession. That's what a lot of people think, but it's weird. We're having a huge juxtaposition because you see indexes right after Powell announced that the Fed was raising rates. Well, they all rallied and actually did well on the week. So the Dow up 10 points, S&P 500 up 1.1%, NASDAQ up 2%. The S&P capped its best January since 2019. The NASDAQ notched its strongest January in 22 years. So very, very odd to see this kind of trend. And we look at the NASDAQ right after Jerome Powell made these interest rates rise. You know, it jumped over 100 points in a matter of minutes. And, you know, not sure necessarily why that is, but very, very odd to see.
And Jake now joining us at the desk. Jake, it's the 8th time the Fed's raised interest rates this year. Is there an end to this coming soon?
Well, you know, we're seeing the highest interest rates we've seen since October 2007. I talked about it potentially being in a recession. So if we enter a recession, that will certainly lower. But in terms of it slowing down, I don't think it will. It might kind of flatline a little bit. The latest rise was 0.25% in interest instead of the 0.5 we've been seeing all throughout 2022. So it's definitely lowering, and that gives investors more confidence. Maybe the reason why those indexes went up. But Powell actually mentioned this in the quote during his, his meeting about the rising interest rates. He said, information data received over the past 3 months shows a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we need to substantially more evidence to be confident that inflation is on a sustained downward path.
And Jacob, the Federal Reserve, in order to fight these rising this inflation, their rising interest rates, why exactly is inflation such a concern right now?
Well, inflation is a huge concern when it comes to rising interest rates. I mean, this is directly because the Feds, they want to make sure that companies can't take out as much money to lower prices across the board. Consumer Price Index shows a 6.5% decline in inflation since the beginning of 2023, so it's certainly going down. It's still a lot higher than we've seen before, but COVID-related factors, the war in Ukraine, gas prices, unprecedented stimulus, all things we talked about on market shares before are reasons for those inflation rates being so high.
All right, Jacob Goldberg, it's going to be interesting to see what happens. Coming up on Market Shares after the break, Sean Dempsey's in studio to break down his top movers for the week. Stay with us.
Adventure can be found anywhere, but the best place to start is in the forest.
I spy something beginning with S.
Snow?
No.
Snow-covered trees?
Nothing to do with snow.
Head outside to discover incredible animals and beautiful plants that come together to create an unforgettable adventure.
Wow.
So grab your loved ones.
Don't even.
And explore a world of possibilities.
Come on, this way.
Visit discovertheforest.org to find the closest forest or park to you.
Welcome to my house. Lately, not my happy place. Everybody's pretty tired of each other. The parents were not themselves. My little brothers were morphing into small creatures. The walls were closing in. Clearly, a case of too much family, too close, 24/7. And there's a lot of that going around right now. If this sounds like your house, try going someplace new. YourLifeYourVoice.org. You'll find lots of ideas to help you handle the family stresses of being confined to close quarters. YourLifeYourVoice.org. It might not get you out of the house, but it could help you find a little more breathing room.
If you see news happening on campus, in Syracuse, or across the nation, call the CitrusTV newsroom, 315-443-1177, or tweet at CitrusTV News, your campus news leader.
Welcome back into Market Shares. We hope you're having a great morning. Joining us in studio now is our financial analyst, Sean Dempsey. Sean, tell us a little bit about some of the stocks you've had your eye on.
Thanks, Tegan. I'm going to be breaking down 3 stocks today, and the first one I want to start off with is the e-commerce giant Amazon. The company beat Wall Street expectations in their earnings this past week. Amazon reported almost $150 billion in revenue in Q4, which is up 9% year over year. On top of that, Amazon Web Services, which has carried the stock for the past few years, underperformed. AWS accounted for only 20% of Amazon's total revenue. On the earnings call, Amazon management said that they expect AWS to stay the same or decline in Q1 of 2023. Is this bad news for investors? Yes, but the stock is on a fire sale right now when compared to last year. As you can see from this chart here, Amazon bouncing back from their lows and now up very, very high as of recently. Next stock is another company that has been the news as of late is Meta. Their stock price soared 23% on Thursday after a massive Q4 revenue beat. This was the best singular day for the stock in over a decade. You'd have to go back to July of 2013 to find a better day for the tech giant. A big reason for this was the $40 billion stock buyback that was announced. Company shares now sit at their highest point since September of 2022. Zuckerberg has been dragged into a lot of controversy after massive company layoffs, yet his comments after earnings were well received by analysts. According to Zuckerberg, 2023 is going to be the year of efficiency for Meta. Now, as you can see on this stock chart right here, Meta is doing a lot better than they were before, bouncing back from lows, mostly because of the overall market doing much, much better. Last stock that I want to go over is to stray away from the tech industry. The last stock that I want to go over is MasterCard. The credit card company finished the week up a little over 1%, and over the past 6 months is actually in the green. A big reason for this is their cashback rewards and more people opting to use credit instead of debit and cash. The company has sky-high profitability and has fared well in a shaky economy. Not only is this company a great short-term investment, it's also a good long-term play as well. I can tell you one thing, people aren't going to stop using credit cards anytime soon. Now, as you can see on this stock chart right here, MasterCard doing a lot better, bouncing off of its lows in early October, and it's sitting at $373 per share. Pretty good investment for people investing into the stock market. MasterCard up over 30% in its lows in October, and MasterCard has been on par with other competitors like American Express when it comes to cashback opportunities and other card rewards as well.
Thank you, Sean. Sean now joining us here at the desk. So you mentioned Meta profits, but it's interesting. We're seeing a lot of layoffs around the tech industry. But then we have the big jobs report this week. So what does that say about the tech industry in its state right now?
Yeah, you make a great point, Bradley. The tech layoffs are mostly because the companies want to keep their profitability and have good earnings on their balance sheet, so their stock price goes up, right? And as a result, they have to lay people off because they have to pay them. And unfortunately, it's weird because the jobs report did come out very, very well, just not for the tech sector.
Right. It's funny, you look at some of these companies, like now Twitter basically has like no employees left.
Yeah, I mean, you look, it's... unemployment is at the lowest rate it's been since 1969. It's at 3.4%, which is, crazy compared to what we saw last year. So it'll be interesting to see how these companies reflect from here on and how it affects them with their layoffs and their hirings. But that is all the time that we have on this edition of Market Shares. Thank you so much for joining us, and be sure to follow us on Twitter and Instagram at CitrusTV News and like us on Facebook. I'm Tegan Brown.
And I'm Bradley Hoppenstein. Have a good morning.